Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at MarketSite is Phil Mackintosh, chief economist at Nasdaq, to discuss market reaction to the Fed rate hike. We'll also discuss inflation and, of course, what we are expecting for future hikes. It's a lot to put into one sentence there. Phil, great to see you as always. Welcome back to Trade Talks. And I just want to take a look at the market prior to the Fed rate hike we just got at 2 p.m. Eastern, which was pretty well telegraphed.
That's true, and basically the Fed's done what the market expected, which is increased to 7 hikes through the year. So it's kind of interesting, right? It looked like the Fed was behind the curve, but they've caught up both times. So the market's not reacting too badly because what the Fed said is what the market was kind of pricing into futures. But if we sort of think about it before the Fed hike, we've obviously got the Ukraine war, we've still got inflation as a story, we've still got employment stresses as a story, and so the market's been pretty volatile. We've had some big ranges during days. We had almost all the markets hit bear market territory, and then they bounced the last couple of days, and this morning we started pretty positively. The reaction to the rates announcement's been a little bit negative, but the market's still up.
Yeah, it's been interesting to see how, all the major averages and commodity indexes round trip even in the same day, which is really quite astonishing for a prolonged period of time. Now, the primary motive behind rates is to tamper inflation. Do you think it's going to peak soon, potentially?
That's the theory. So if you look at the reasons that we have the 7.9% inflation right now, a lot of it is car prices are really high. That's because of the chip shortage. But as the chips start to get produced and as the inventory, which is already starting to builds more, you should see competition for cars basically bring prices down. That's actually going to be deflationary. That's going to help pull inflation down. There's a lot of energy price inflation, and so as we start to get into summer and the food starts to open up again because everybody's back at work with COVID gone, we should also start to see that go out of the inflation numbers. The thing that's kind of a missing link right now is what happens with energy prices, because that's a huge portion as well. And the last week we've seen oil prices go up from 90 to 120 plus, and then come all the way back down to 100. So if they come back down and stay below 100, we actually don't get any increase because of oil, but it will hold inflation up a little bit because it's much higher than it was 6 months ago.
Right, and it's really interesting because when we were talking about this before the Omicron variant, that really was the theory there, right? It was essentially the same theory that we're looking at now, but when you talk about energy prices, when we think about demand destruction, which could potentially occur with Ukraine, which we know it's going to do to energy, we know how it's going to impact the supply chains, could that conflict potentially make inflation worse?
I think the short answer is yes. And what's actually happened with the market is you saw the 10-year interest rates. Initially, they went down when the conflict started because everyone was worried about the impact on GDP and growth slowing down. And then suddenly we thought about all the commodity prices, all the commodities that, to your point, Ukraine and Russia manufacture. The prices of them have gone up because probably the supply is going to be depressed while there's a conflict. And so all the commodities are going to make it more expensive to manufacture things, more expensive to transport things. And so that's going to pull inflation up. Worse in Europe than it is in the US, and that's because we don't actually import that much Russian gas or that much Russian oil. But Europe, because they're right next door, do. And so the Europe impact on GDP is meant to be much higher than we're expecting, and a lot of people don't really think we'll slow down much at all.
Right, and then what is the market expecting in terms of additional rate hikes? We know dot plots suggest 7. Is the market thinking anything else?
Yeah, so the market had come from 7 a couple of weeks ago down to 5 when the Ukraine crisis started. It had gone straight back up to 7, and so the market was pretty much spot on what the Fed's now decided to do. And so right now, basically what the Fed has caught up is where the market was pricing in. That's going to get us pretty close to 2%. 12 months from now on a short-term rate. And you think about it, the 10-year has gone up 30 basis points in the last week or so, but it's only at 2.15, 2.16. So basically the short term and the 10-year is very close to the same rate. That's got a lot of people talking about recessions because if the short term rate's past the 10-year, historically, that starts to make people think about the recessions, and eventually we probably have one.
One more question let me throw at you with the concern of inflation and the challenge it's going to be tampering it. What do you think about corporate earnings? It's got to be a challenge if you don't know what input costs are going to look like and how you're going to maintain margins.
Yeah, so you've got two issues really. If there's lots of inflation, people have less spending as well, so they're not going to be buying as much stuff in terms of products that you can sell, as well as the corporates have higher costs, squeezing margins. And if you look at the earnings, we had really strong earnings last year. Already analysts are starting to revise earnings down, and the growth this year is not going to be anywhere near as strong as the growth in earnings last year, but still expected to grow. So that's going to help offset some of the impact of rising rates.
All right, Phil, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.